This is a quick look at ZB, and I want to keep this simple. So, here's the trend so far off of the 2020 highs, and we've been talking about this structure here potentially becoming a five-wave structure. So it would be, starting here would be a 1, ABC into a 2, down into a 3 that pokes below this channel, up into a 4, and then we would see maybe a 5. I mean, towards the end of the year, again peaking below this channel, which would be down there. That's sort of the structure that we're looking at. And so, the question here, and note that the wave 4, if that's what this is, stopped one tick below the bottom of the wave 1 over here. That's what this red line represents is, you know, bond bears don't want to see overlap here, and we got zero overlap. So, I mean, let's consider the bull case first. If you're bullish on bonds, you want, I think, keeping it simple, you want to see this as some sort of five-wave impulse move off the bottom. There's some sort of correction here. You want to see this as a wave 3 up and this as a sideways to down corrective wave 4. And the issue with this scenario is if we zoom in on this initial move here, let's get in. If this is a 1 up and a 2 down and a 3 up and an ABC 4 down, the top of wave 1 right here, you can see the problem. If you look right, you get 1, 2, 3, 4 days of this supposed wave 4 spiking down into this level. And so the question is that the market just gamesmanship, being cagey and making, just like they dip into 618 fib levels sometimes and then go away? Or is that the bond market, is that a tell saying that this isn't really an impulse wave, that this is some sort of 3, 3, 5 corrective move? It's also worth noting that, this if this is a fifth wave, if we draw the weekly extension from the bottom of this wave down, it traded into its 50, and then that supposed fifth wave got crushed by more selling at this price level right here. So this is all to say that if you're trying to view this as an impulse off the bottom, it's a hugely unimpressive one. And it sure is easier to see this as some sort of WXY or ABC correction. And so if we look at the price action lately, actually let's go to the 2-hour chart. Okay, again, here's that high, and we've been in a channel ever since. And so if you're bullish, you want to see this as a fourth wave, and you want to see this as some sort of 1, 2, 3 W, 1, 2, 3 X, 1, 2, 3 Y kind of correction. And if we switch back to the daily, so a series of three-wave corrections down into what would be, drawing the fib here, which would be the long from lows, right? And this red line here, if this is the top of a 1 up, you really don't want to see daily closes below this red line. And so it sort of coincides with the 50. Oops, I just moved that. And so I think, if you're bullish, they really need to hold this zone right here. And I think that's all you can say about the bullish case. You want this to be the bottom of a correction on a larger degree of trend, and you're trying to build a five-wave move off the lows. And so, it kind of seems like you really need to hold that zone. So let's look at the bearish case now. You know, back on this, I mean, you know, bears are looking for 5 waves down. It's that simple. And you're not viewing this as a 1 2 3, you're viewing this as a WXY, and then this in here, again going back to the 2 hour chart. We've been, one of my favorite trading view features is how you can have indicators from different time frames on the same chart. So this is the 200-day moving average, and you can show it on every time frame in days. So this is the 2 hour chart, but the 200-day moving average, and you can see we've kind of been oscillating around it. And so if you're bearish, you want to be looking at, there's a long from lows if you're bullish. If you're bearish, you want to be looking at the short from highs. And so you want to see this structure as a series of 1 and 2s. 1 2 1 2 1 2. We're building bearish energy to make a significant move lower, which may have started here. I think that was after the close on Fed Day, if I remember that right. But the short from highs is, this was almost a full retracement. This was just a lower high. But if we start looking at this one, then we see, I think this, yeah, the 786, it's sort of stuck there. The next one was the full 50 retracement, right? And so we traded the short from highs on Fed Day. They sort of front ran it, they came back to it, and then after the close, I think this was the Asian session, they just hammered it. And it is interesting how the Asian session has seen selling, and then the New York session has seen buying. So we're coming into, if the long from lows, it was right in here, it's not drawn anymore, is basically lines up with the target of this short from highs. And so we're going to come into this zone in an oversold condition. So I would guess that we'll probably get some sort of bounce here. But what bears want to see is that's going to be short-lived. Maybe we'll retrace some portion of this wave, but then we want to make short work of that and go and just continue down. And back to the daily chart, the other thing I was looking at is just in terms of time and corrections. If you look at this wave 2, did I draw that correctly? Yeah, that's pretty close. It's about a 10% correction that took about 99 days. And then if you're viewing this as a wave 4 to that high, that was about a 9% correction that took 86 days. So they're generally comparable. And so that's the way I'm looking at this. The short from highs meets the longs from lows. There's going to be a little battle here, and we'll see if we get continuation out of this nested series of 1s and 2s, lower highs and lower lows. Is that everything I wanted to say here? Yes, it is. And so my target, well, let me talk about this. So, we see this pattern over and over again where, a third wave, if that's what this is, and a fifth wave, this is a better example, a third wave and a fifth wave, there's a wick right there punching above the channel. Just like on this down channel, we're looking for a third wave and a fifth wave to punch below the channel. And if we go to the weekly chart over here, that's a fractal, the little channels we just looked at on the 2 hour chart. And this is the weekly log channel going back decades. And we see the same fractal, right? We see a punch above, we see it once here in what might be a third and a fifth, and then we see it in this relationship, which might be a third and a fifth. So, I'm not a macroeconomist. I don't make big theses and trade against them. I'm a tactical trader, but I try to follow smart people who are macroeconomists. And, there are people who are saying that this is the top. This blow off here is the top of the 40-year secular bull market in bonds, and we are now entering an inflationary regime. And so I just wanted to call your attention to this, this fractal and how it looks exactly the, it's what we see on smaller time frames right there. So, and I think Rawl Powell is one of the main deflationary guys that I follow. And he argues that technology and demographics are deflationary. But he recently tweeted something that said, the case for inflation is that the corrupt establishment who ran up the national debt will now try to inflate it away by essentially using inflation to devalue the debt, and that inflation is essentially stealing from the masses, right? You're devaluing their savings, their ability to earn. And so that's what shorting bonds means. You're betting that the establishment is going to do everything it can to inflate away the debt, preserve itself at the expense of the masses. So that's my 2 cents on the macro picture. Is there anything else I wanted to say about this? I mean, it would seem that after the Fed, we're heading for some sort of resolution here in the middle of this range. That being said, I mean, if this is a fourth wave, nothing says we can't continue to chop around here for weeks or months. Um, but I am sort of leaning towards this resolving to the downside here. And I think that's everything I wanted to say. Okay, thanks.